we will cut the RRR and policy rate. We will also cut central bank policy rate, the 7-day repo rate. At the same time, we will guide the LPR and the deposit rate downward. We will also set up a special relending program for increasing the holding of shares. We will enhance the quality and value for investment of listed companies to better serve investors. We will make use of stocks, bonds, and futures, among other capital market tools, to invigorate the restructuring and M&A market.
Yeah, that was a throwback to almost exactly a year back to really, I think I speak on behalf of the whole team, that jaw drop moment.
I remember it just like yesterday. We're like, literally on air.
What are they saying? Did they just say that?
Cut rates on live TV at 9 o'clock in the morning?
Did they do that on top of cutting interest rates? So since then, we've actually made a tally here. 30 basis points of rate cuts. I know it doesn't sound like, relatively speaking, 100 basis points of reserve ratio requirements. On your screens is the performance of the market. First green line is the Big Bang moment. DeepSeek is in yellow. Liberation Day is in red. Monetary easing, which is I think the most recent round was early June, late May, early June, and of course this recent second détente that we've had on the trade conversation. Markets rallied through pretty much most part of that, but of course a lot of that has been taking place recently, Yvonne.
Yeah, so you got to wonder, right now, is the PBOC expected to ease further this time with the economy still under pressure and the Fed cutting rates now? This is what we heard from Pang Gongsheng yesterday, right, at that press briefing late afternoon. China's monetary policy focuses on domestic priorities while considering internal and external balances. Now, the PBOC has made clear our macro-level principles of determining monetary policy. So pushing back a little bit on the expectations out there that they can cut or when they should cut.
Yeah, or the urgent need to do so,
yes.
I think. Johanna Chua still here with us, head of EM economics at Citigroup Global Markets. So, since last year, what's changed?
That's a very good question. I mean, obviously, the PBOC presser was an unusual kind of press conference. And I think there was, aside from the rate easing, there was definitely a strong policy signal about supporting asset prices, including both housing and equity. But of course, a year later, I think they've been more successful on fueling the equity. Obviously, it's been helped by DeepSeek and other policy efforts like anti-involution. But the property market, I mean, we've had a little bit of rebound in the last quarter, first quarter, but it kind of fizzled. So real estate, property is still a big problem. So at least on asset prices, the record is still mixed. If you look at, we shouldn't look at PBOC press conference in isolation. There was a series of events that happened, right? We also had the unusual Politburo meeting that happened in September, and then we had a number of policy steps that were happened. And there was a lot of communication about supporting consumption, supporting demand, kind of an effort towards rebalancing. But we take a year later, look at the data, I would actually argue that China's growth would arguably is even more unbalanced. Like the contribution from net exports to real GDP growth has even gotten larger.
So you're seeing cheap exports basically all around the world, except for the U.S. in some ways, right? I mean, is this going to be sort of a problem?
Well, this is the debate, right? I mean, yes, the first half of this year, they exceeded their real GDP growth, 5.3%, but a lot of it, more than 30%, was coming from net exports. And the question is, and if you look at the recent data, export growth has been relatively resilient in China. For all the fear about tariff, it ended up that China's tariffs was not so bad relative to India or even ASEAN, the tariff differential. Meanwhile, if you look at the latest data, we've seen, especially in August, we've had a number of weaker data, not just on the supply side with capacity cuts and the fact that investment has slowed down, even manufacturing investment, but also on the demand side, right? We've had the fiscal front loading and that came off. So I think the worry is, again, the growth is still very, very unbalanced. A year later, we're still now debating whether you're going to need another policy support going into September Politburo meeting. And then with the fifth plenum coming up in October, there's a lot of a debate whether this is really sustainable. China really needs to boost demand much more relative to supply. Otherwise, running these large trade surplus, and much of this is growing at the expense of the global south, thus create, obviously, some challenges for other competing manufacturing in the region, whether it's Europe or even kind of the lower value added, like, Indonesia or India, where they're losing market share on labor-intensive manufactured goods.
So you mentioned fiscal easing needs to take up a quasi, financial fiscal easing needs to take up a bigger portion of this. A lot of that has so far gone into things like debt resolution, managing the fiscal burdens of local governments. How much is needed for pro-growth fiscal stimulus, like directly pro-growth, pro-demand fiscal
So
stimulus?
China needs, both fiscal and structural reform, right? Structural
Right.
reform to kind of rebalance. So you're right. There was a little bit of consumption support. We did see, for example, the consumer trade-in program.
Yes.
We saw the child care subsidy.
Yeah.
There was even something for elderly care.
Yeah.
But, have we seen something bigger enough to get people to remove kind of the precautionary savings behavior? And I think when we look at excess savings and household deposits, it's still very, very high. So obviously some of that at least is fueling into equity market, but the equity market rally is really not enough to drive kind of a household wealth effect, second round effect. Because, Chinese households are not like U.S. households. They don't have 401ks, that type of big source of wealth. You really need something to kind of generate a little bit more kind of a confidence in terms of saving. So again, the debate is whether we will see more reform of the Social Security welfare pension reform, which again, we will see what will happen in the fifth plenum if there'll be strong signals with that. We will probably still see more rollout of targeted kind of consumption support, whether it's, again, more kind of nationwide, making it permanent, more forward-looking for elderly care or child care subsidies or unemployment insurance, etc.
Yeah.
But the other thing is the trade-in program. After we've launched this kind of durable goods trade-in program, and a lot of that was already front-loaded. After you buy an appliance, you're not going to buy it again.
Yeah.
There's a lot of talk, since there's a lot of talk about services. Maybe the next round will be an extension of the trade-in program for services. But you need services sector because you need to create more jobs.
Yeah.
I think the problem is you still have jobs income, and we still haven't addressed or nipped the bud on deflation pressures.
It brings to question anti-involution, right? Because as you mentioned, all those sort of challenges that you highlighted come from the intense amount of price competition. People are overworked. It's causing a lot of labor shortages and the like. So anti-involution, in order for this to succeed, what does it have to look like beyond just supply side cuts?
Right. Look, anti-involution, that's only one side.
Yeah.
Just trying to address some of the excess capacity. If you're just going to focus on anti-involution and nothing on the demand side, well, then growth will really slow down. So the issue is really, you really need more demand support. And on the anti-involution, obviously a lot of people are focused on certain sectors like steel or cement or coal or maybe battery, solar, kind of the clean tech price,
Yeah.
The question is whether, again, if we have a proper rebalancing, whether other sectors might also be targeted for anti-involution. Of course, the question is how successful you'll do that, but whether it will extend to other industries like chemical industry, where there's a lot of kind of anti-dumping, anti-trade policy, which is impacting a lot of global kind of other competing industries.
Yeah.
But like I said, you really need more on the demand side because, in the last couple of 5-year plan, when China does supply, they're very good.
Yeah.
But when it comes to demand, it's kind of doesn't really quite work. And if you're going to do the other opposite, where you're curbing supply, but you're not really supporting enough demand, then there's going to be a downside risk to growth. And I think they still need to do more on the demand side because you need to achieve your developmental goals.
There's a lot of talk about new growth drivers. And is AI going to be one of them, given just the technological breakthroughs, the productivity gains that could come through it? Is that going to be something that could
it's one of
offset
them, but
this?
it's not enough. It's obviously an important part of it, but, you still need to create jobs, right? You can make an argument that AI could create also a lot of potential disruption in terms of labor market creation, job creation at a time when you have still very high youth unemployment. So, you need really more services. That's a sector in the economy, the consumption services sector, that's still relatively underdeveloped, where I think there was this piece from the IMF last year saying relative to a stage of development, services sector in China is still like 20%, lower than what it should be. And again, part of the concerns about services sector in China is it's still very heavily regulated, lots of, state intervention, state control, and state ownership, and service trade restrictiveness. The liberalization of services trade has also been lagging what we've seen in the manufactured goods trade.